In 2007, Warren Buffett, the most famous investor alive, made a public bet for $1 million. He bet that a simple, boring, do-nothing index fund would beat every hedge fund on Wall Street over the next 10 years. Hedge funds are run by the smartest people in finance, MB from Harvard and Wharton, analysts with Bloomberg terminals running 24 hours a day, teams of researchers tracking every market movement on the planet. They charge enormous fees for all of this expertise, and they lost, not by a little. The index fund returned 125% over the 10 years. The average hedge fund returned 36%. The people paid millions of dollars to beat the market, couldn't beat a fund that just sat there and did nothing. That story is the entire lesson of this video. But I'm going to show you exactly why it happened, what it means for your money, and the single most important investment decision a beginner can make, which takes about 15 minutes to set up, and then never needs to be touched again. Here's what we're covering today: what an index fund actually is, and why it works, what an actively managed fund is, and why it almost always underperforms, the fee problem, and why 1% doesn't sound like much, but costs you an absolute fortune over time. The one fund portfolio that outperforms most professional investors, and the exact steps to buy your first index fund today. There's one thing I'm saving until later, a number about fees that, the first time I saw it, made me genuinely angry. I'll get to it after we cover the basics. Let's go. Let me start with the concept before the numbers. A stock market index is a list, a collection of companies grouped together to represent a section of the market. The most famous is the S&P 500, which is simply a list of the 500 largest companies in the United States. Apple, Microsoft, Amazon, Johnson & Johnson, Berkshire Hathaway, 500 of them. An index fund is a fund that tracks that list. It buys a tiny slice of every company on it, in proportion to their size, and holds them. It doesn't try to pick winners, it doesn't bet against losers, it just holds them all and moves when the index moves. Here's the analogy I want you to carry through this whole video. Imagine you're betting on a horse race, but instead of trying to pick which horse wins, which requires expertise, research, and a lot of luck, you buy a tiny stake in every single horse. You don't win as much when one horse wins big, but you never lose everything when one horse loses. And over hundreds of races, the total value of all horses tends to go up. That is an index fund. You own a tiny piece of every horse. You win when the race overall goes well. You don't need to be right about any individual horse. Now here's why this matters so much. The United States stock market, measured over any 20-year period in history, has never produced a negative return. It has had crashes. It has had corrections. It has had years that looked terrifying. But over every rolling 20-year period ever measured, the total market has gone up. An index fund captures that, all of it, without you having to decide anything. The most popular index funds, VOO, VTI, VT, have expense ratios as low as 0.03%. That means for every $10,000 you invest, you pay $3 per year in fees. $3. Keep that number in your head. We're going to come back to it. Quick recap. An index fund tracks a list of companies. It buys a slice of everything rather than trying to pick winners. Historical 20-year returns on the total U.S. market have always been positive. Expense ratios are as low as 0.03%, $3 per year on $10,000. Now let's talk about the other kind of fund, The one most people's 401ks are quietly full of. The one the financial industry has a significant incentive to sell you. An actively managed fund employs a team of analysts and a fund manager whose job is to pick stocks they believe will beat the market. They research companies. They analyze earnings reports. They meet with executives. They use sophisticated models to predict which sectors will outperform. This sounds like a service worth paying for. If they can consistently beat the market, the extra fees make sense. Here's the problem. They almost never consistently beat the market. According to Spiva, the most cited index versus active fund comparison in finance, over any given 10-year period, between 85% and 92% of actively managed funds underperform their benchmark index. Not a few, not half. Between 85 and 92%. And the ones that do outperform in one decade almost never repeat that performance in the next. The research on this is overwhelming and consistent. Short-term luck gets mistaken for long-term skill. The fund gets hot, attracts more investors, becomes harder to outperform with, and then reverts to underperform. Now here's the thing. This isn't because fund managers are bad at their jobs. Many of them are genuinely brilliant. The problem is structural. In a market where thousands of brilliant, well-resourced people are all analyzing the same information and competing to buy undervalued stocks, there are very few genuinely undervalued stocks. The competition itself eliminates the advantage. This is called the efficient market hypothesis, and while finance academics debate its limits, the performance data is hard to argue with. The person trying to beat the market is usually competing against other people trying to beat the market. Most of them cancel each other out, and then everyone pays fees on top. Quick recap. Actively managed funds pay teams to beat the market. Between 85 and 92% of them fail to do so over 10 years. Short-term outperformance is mostly luck. The competition eliminates the edge, and everyone pays fees, win or lose. I told you there was a number I was saving. Here it is. The average actively managed fund charges somewhere between 0.5% and 1.5% in annual fees. Some charge more. For this example, let's use a conservative 1%. 1% doesn't sound like much. It's a rounding error. It's what you tip at a coffee shop. But applied to a long-term investment, 1% is not a rounding error. It is a wealth-destroying machine. Let me show you the actual numbers. You invest $10,000 at age 25. You add $300 a month. You do this until 65. Market returns average 8% per year. With an index fund at 0.03% fees, you end the period with approximately $1,020,000. With an actively managed fund at 1% fees, same returns, same contributions, same 40 years, you end with approximately $762,000. The fee difference is 1%. The wealth difference is $258,000. 1% per year, compounded over 40 years, costs you $250,000. And remember, the actively managed fund almost certainly didn't even match those 8% market returns. It probably returned less. So the real gap is likely wider. This is the quiet contract most people unknowingly sign when they don't pay attention to their fund's expense ratio. You hand over $250,000 in exchange for a manager who statistically would have been better replaced by a spreadsheet. I promise to get angry on your behalf. That's why. Quick recap. 1% annual fees versus 0.03% fees. costs approximately $258,000 over 40 years on a modest investment. Fees compound just like returns do, but they compound against you. Always check the expense ratio before choosing any fund. You've been patient with the theory. Here's the practical payoff. The one-fund portfolio is exactly what it sounds like. One fund, one decision. Set it up once. Never touch it. Here are the most commonly recommended options for a U.S. investor. VOO, Vanguard S&P 500 ETF. Tracks the 500 largest U.S. companies. Expense ratio 0.03%, one of the most owned funds on the planet. VTY, Vanguard Total Stock Market ETF, tracks the entire U.S. market, including smaller companies. Expense ratio 0.03%. Slightly more diversified than VOO, VT Vanguard Total Stock Market Index Fund, the mutual fund version of VTI, often used inside retirement accounts. Expense ratio 0.04%. If you are outside the United States, look for a global index fund tracking the MSCI World Index, or a local equivalent from Vanguard, BlackRock, or iShares. The expense ratios are slightly higher, but still far below any actively managed fund. Any of these three is a legitimate answer to the question, what should I invest in? For a beginner, the difference between them matters far less than the decision to start. Now here's the habit that works alongside the one-fund portfolio. It's called dollar cost averaging. Instead of trying to time the market, waiting for a crash, waiting for the right moment, you invest a fixed amount on a fixed schedule, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When the market is up, your fixed amount buys fewer. Over time, you automatically buy more when it's cheap and less when it's expensive, without thinking about it, without watching the news. Dollar cost averaging is not exciting, it is not clever, but it is what the data consistently shows works better than almost everything else for the average investor. Because the average investor who tries to time the market doesn't. They wait too long. They get nervous. They miss the recovery. The best time to invest was 20 years ago. The second best time is today, on a schedule, every month. Quick recap. VOO, VTI, or VT for US invest. Global equivalent for international. 0.03 to 0.04% expense ratio. Dollar cost average monthly. Set it and do not touch it. No more theory. Here is exactly what to do. Step 1. Open a brokerage account if you don't have one. For a taxable account, Fidelity and Schwab are both excellent, free to open, and have no minimum investment. For a tax-advantaged account, use your 401k portal if you have one at work, or open a Roth IRA through Fidelity or Schwab. Step 2. Search for your fund. In the search bar, type VOET or VT. Check that the expense ratio matches what I described. It should be 0.03% or 0.04%. Step 3. Set up a recurring buy. Not a one-time purchase, a recurring monthly investment on your payday. The exact dollar amount matters less than the habit. $50 a month beats $0 a month. $200 beats $50. Start where you can and increase over time. Step 4. Do not watch it obsessively. Markets fluctuate daily. Your investment will go down in value sometimes. That is not a malfunction. That is the market. Selling when it's down locks in the loss. Doing nothing is almost always the correct move. Step 5. Rebalance once a year. Once a year house, not once a month. Check your allocation, make sure nothing has drifted significantly, and adjust if needed. For the one fund portfolio, this step barely applies. That is the whole system. Most of it takes under an hour to set up, and then it mostly runs itself. Links to the platforms I'd recommend are in the description below. All free to open, all beginner-friendly. Quick recap. Open Fidelity or Schwab. Search VOO, VT or VT. Set up monthly recurring buys. Ignore short-term fluctuations. Rebalance once a year. Done. I want to finish with something that might sound strange coming from a finance channel. The best investment strategy for most people is boring. It is not exciting. It does not make for great dinner conversation. You cannot impress anyone at a party by saying, I dollar cost average into a total market index fund every month. There is no story. There is no clever insight. There is no thrilling moment where your genius is confirmed. But it works, consistently, reliably, over time. The financial media needs you to feel like the market requires constant attention. It needs you to believe that every headline is important, every dip is a crisis, every rally is a trend. Because attention is the product. Your anxiety is the revenue. The boring truth is that most people who try to actively manage their investments underperform the people who just pick an index fund and leave it alone. Jim Simons, the greatest quantitative investor who ever lived, ran his fund using an algorithm so complex that even his own staff didn't fully understand it. He was a genuine genius, and he once said that the most important factor in long-term returns for normal investors isn't intelligence or skill. It's the ability to do nothing when everything in you wants to do something. That is compound interest working. That is the index fund strategy working. That is time working on your behalf. You don't need to be clever. You just need to be consistent and patient. If you're watching this and something is clicking into place, if the last 6 videos have started to connect into a picture that makes sense, that is exactly what this channel is designed to do. Money Mastered is not a collection of random finance tips. It is a curriculum. Stock market, compound interest, 401ks, passive income, index funds. Each video builds on the last, and the next one builds on this one. Most people spend their entire adult lives making financial decisions without ever having been properly taught how money works. This channel exists to fix that, one video at a time. If you're getting value from it, subscribing is the single most useful thing you can do. Not for me, because the algorithm shows you what you've already seen, but for you, because YouTube will start surfacing the older videos in this series, and they connect. And if you know someone who is currently paying high fees inside a pension, a 401k, or an investment account without knowing it, share this video with them. That one conversation, triggered by a 15-minute video, could be worth tens of thousands of dollars to them over the next 2 decades. That is not an exaggeration. Next week, we are going somewhere different. We're talking about the psychology of money, specifically why intelligent people make terrible financial decisions, and the 4 mental biases that are almost certainly affecting your money right now without you realizing it. It is one of the most important videos on this channel. I'll see you Tuesday.